oh no, the stock market's going to crash. No, probably not. So anyways, what we're going to talk about today is, will inflation lead to a stock market crash? So what is inflation really all about? Basically, inflation is the cost of goods versus how much money you have. So for example, a cup of coffee. Now, I'm a very bad drawer, but let's say this is coffee. Now, the cost of coffee, let's say right now, is $1. And we get that from the United States. We basically import, as Canadians, most of our goods from the United States. And what does this mean? So, if it costs $1 US for a cup of coffee, just as an example, I know this is way off what it's actually worth, but let's say it's worth $1 US. Right now, this costs us about $1.21 because it costs $1.21 Canadian for us to buy $1 of American money. Now, let's say there is inflation. The costs of goods goes up in price. That would be if the United States started buying coffee from somewhere else, and let's say the US dollar was devalued to a point where now the cost of coffee coming into the United States is now worth $2. Well, let's see. You would automatically assume that the Canadian dollar would mean that we would be then buying that cup of coffee for $2.42. But let's really look at the now new cost of buying it in Canadian dollars. Let's say instead of our Canadian dollar being worth $1.21 for every $1 US, let's say because of the cost of the devalued money, we are now even with them at $1 for $1 like it was back in 2007. Now, if that's the case, we now, instead of it costing $1.21 for coffee, it's now going to cost us $2 for a cup of coffee. Now, this is, again, just making it look like coffee because coffee is a low-valued item. And it allows us to picture what we're talking about. But now it's costing us $2. This is what we call inflation. The cost of goods going up in value because of our currency. And the reason why currencies go up and down in value, the main reason is because of central bank printing. That is the biggest reason right now why they are worried about the currency. Because if you print a lot of money, let's look at it as basketball cards for us all to picture what we're talking about. If I have a one and only Michael Jordan card, and it's a one and only, the only one they've ever made. It was signed by Michael Jordan, and let's say now he's dead, and it's literally the only card that was ever made. But now they're bringing out duplicates, let's say, and that those duplicates also had a copy of his signature on them. Well, let's say these copies were so good that you couldn't tell the difference between the two. Well, now, the value of that one and only basketball card is now down in value because there's now 6 million of those basketball cards. Now, this is, again, just another example, but now, this is what we're talking about money. The scarcity of money goes along with the cost of currency. So for the more money that your country is printing, the lesser value it actually will have. Now, will this happen? It's hard to say, but can this happen? Yes, it can happen, but what would happen to things like stocks on the stock market? Because it's not like a currency or a basketball card that you can print over and over again. As an example, a basketball card, but let's just say money in general, they're printing it over and over again. Well, guess what? If that happens, the cost of things that can't be duplicated will also go up because the scarcity of those are still going to be there versus money where there's less scarcity of it. So when essentially more and more people get more money in their pocket, the cost of everything will go up because more and more people can buy. And then if more and more people can buy, the companies will say, well, I can make more money. And of course, the cost of goods will also go up. That's another example. So this is two different examples that we are playing with. The scarcity of money, but also the more money that everyone has in their pocket. So, for example, stocks, because they are scarce. Sure, there's millions and millions of shares of everything, but it's still a scarce commodity, which means that they cannot be duplicated. A company can't just go to the stock market tomorrow and say, well, I want to dump another 6 million shares on the stock market, because that just doesn't happen like that. Now, technically it could, but what you are seeing happen with currencies or with stocks is if a company was to do that, what you would see happen is not just the cost of the stock go down slightly. Of course, there's more stock on the market for that company, so it would be easier to buy, which would mean the stock doesn't move as high or possibly goes lower, but that would usually come out of the pockets of the owners of the company anyways, so the money's just transferring at that point. The stock is just transferring. So, when we're talking about the scarcity of the stock market, if there is inflation, the cost of the stock market, the cost of stocks will go up. But it's also going to go down when it comes to currency. And what I mean by that is, from an outsider, I could buy, let's say it goes down to even. Right now, for me to buy, let's say, a Tesla share at $500, it would generally cost around, I think it would be like somewhere in the 620-ish range. And at that point, me buying in at $620, to an American, it's only $500, but for me, it's $620 because of currency. Well, now, if the U.S. currency goes down or up, and technically down in value, but we're going down farther. Let's say we grow up in value. Now, if that stock doesn't go anywhere, and it cost me $620, but now my currency is now even with the US dollar, now that stock still lost me money. So there's so many things that you need to really look at. So, will the stock market continue to go higher? That is the question. Well, if there's a temporary boost to the inflation, and then it dips back down, which is what they think is going to happen, and then it continues to ride along, this is most likely what we're going to see with our stock market charts. Because we have to remember that these stocks are not just on the US stock market, they're multinational. They're sometimes on the European stock markets. They're sometimes on the Canadian stock markets. For example, TD is on the US and Canadian side. So we have to really, really look at the difference in how many people own the stocks on either side, and how much stock is on either side as well. There's so much different math that you have to look at. Personally, I think that the economies are going to be just fine. I don't think that there's going to be any massive change. However, if there is, if you hold a dividend-paying stock and you still believe in that stock, hold on to it because it's still paying you. If you're holding a stock, something like a Tesla, where it's not paying a dividend, at that point, you really need to pay attention to what the inflation is doing and what the currencies are doing, because then you need to know, will this be a good stock into the future? Obviously, it's going to be really good, but when it comes down to currencies and things, is it good for your portfolio? I hope that this has kind of given you some information on how it works. Make sure to go hit that like button and subscribe, and I'll see you guys again next time.